All right, welcome to The Explainer. Today, we're taking a super fascinating look right under the hood of a highly specific, high-stakes options strategy. Okay, let's dive into this because we are looking at All-Star Chart's chief options strategist Sean McLaughlin's brilliant tactical approach for Alphabet heading into its July 2026 earnings report. This is literally a masterclass in navigating an expensive market, and by the end of this, you're going to understand exactly how the pros attempt to tilt the odds in their favor when the stakes are at their absolute highest. So here's our structural roadmap so you know exactly how we're going to demystify this complex trade piece by piece. First up, the Alphabet earnings setup. Then the high volatility problem. Third, the risk reversal strategy. Fourth, winning 4 out of 5 scenarios. And finally, the downside risk. Okay, let's kick things off with Section 1, the Alphabet earnings setup, specifically the pre-earnings market context. So leading up to the July 2026 earnings, Alphabet stock had been stuck in this very specific, tightly bound channel. For about 6 to 8 weeks, it just kept bouncing between $330 and $375 a share. You know, when a massive tech stock coils up in a tight range like this for 2 whole months just before an earnings report, it essentially creates a pressure cooker. The market is just waiting for a spark, a catalyst, to send it completely breaking out of this channel. And that catalyst was setting up to be a really big one. McLaughlin was notably bullish on a breakout here, and for good reason. Analyst sentiment was largely positive, with price targets sitting well above current levels. Plus, there was this massive focus on Alphabet's cloud and AI growth just fueling all this optimism. Because of all this, the options markets were actually pricing in a sizable 6 to 7% swing in the stock price right around the earnings event. But, and here's the catch, this massive anticipation builds into a pretty major obstacle. Which brings us to Section 2, the high volatility problem. Basically, the main antagonist of our trade. Now, if you're bullish on a stock, the simplest thing to do is just go out and buy call options, right? But here is the roadblock. Leading into earnings, something called implied volatility, or IV, absolutely skyrockets. IV is simply the market's forecast of a likely movement in a security's price. Because earnings are, well, uncertain, IV stays super elevated, which makes options incredibly expensive to buy. But the really crucial point here is what happens next. It's the dreaded IV crush. The very moment earnings are announced, all that uncertainty just vanishes. That high volatility rapidly collapses, which instantly destroys the premium value of the options you just bought, even if the stock actually moves in your direction. Now, what's really interesting about this is Sean McLaughlin's exact phrasing for this situation. He describes buying outright calls in this elevated IV environment as paying through the teeth. It is painfully expensive. You are essentially paying a massive premium just for uncertainty, and you're almost guaranteed to lose a huge chunk of that premium to IV crush the very second those earnings numbers hit the wire. So the big question is, how do you play a bullish breakout without paying through the teeth? That leads us right into Section 3, the risk reversal strategy. This is Sean McLaughlin's clever workaround. You see, instead of just buying a standard call option, McLaughlin utilizes a two-legged spread, often called a risk reversal or a synthetic long. On side A, he's buying the August 375 call to capture that upside breakout he expects. But to avoid paying that massive premium we just talked about, on side B, he simultaneously sells the August 330 put. By selling that put, he collects a premium. He then turns right around and uses the money collected from selling that put to totally finance the purchase of the expensive 375 call. By executing this specific two-legged trade, McLaughlin becomes what's known in the biz as net short premium. Let's walk through exactly how this fundamentally changes the game. Step 1. It drastically reduces your upfront capital outlay. You aren't paying through the teeth anymore because that sold put is footing the bill. Step 2. It actually hedges against that post-earnings IV crush. Remember how we said IV crush destroys option value? Well, when you're a net seller of premium, you actually want that value to evaporate. The crush works totally in your favor on the leg you sold. And step 3, if the stock drops moderately, this setup establishes a really favorable entry point to actually buy Alphabet shares at a nice discount. Moving on to Section 4, winning 4 out of 5. Let's break down the actual scenarios. And this brilliantly illustrates why McLaughlin absolutely loves this structure. If the stock shoots sharply up, you capture significant profit on the long calls, and those short puts just expire completely worthless. It's a total win. But what if the stock just stays flat or goes slightly up? Which, by the way, actually represents 2 of our 5 potential outcomes. With a standard call option, you'd be bleeding money to Ivy Crush. But here, the premium you collected from the put helps offset those losses. Both legs can actually work for you. Okay, so what if there's moderate downside? Well, you might be assigned the stock at $330, which McLaughlin views as an effective, highly desirable long entry point for Alphabet anyway. As McLaughlin framed it, because the flat and slightly up outcomes are combined favorably here, this structure allows a trader to win or at least find a totally acceptable outcome in 4 out of 5 possible market scenarios. The options market is literally paying for your bullish exposure. But we do have to talk about that fifth scenario, the one where this trade goes horribly, horribly wrong. Which brings us to our final section, Section 5, the downside risk, the catch of the naked put. Now, before we look at the exact mechanics of that risk, it is absolutely crucial to state clearly, this explainer is an objective analysis of McLaughlin's strategy based on our source material. This is not financial advice, and we are not endorsing the trade. Options trading involves a very significant risk of loss. Advanced strategies like risk reversals require a deep, deep understanding of the Greeks, margin requirements, and the complex rules of assignment. So please always consult a professional. All right, so here is the sobering reality of the risk reversal. This is absolutely not a defined risk trade. When you sell that August 330 put to finance your call, you're selling a naked put, and that carries massive, serious tail risk. If Alphabet stock experiences some sort of catastrophic event and drops sharply below $330, your losses will accelerate point for point on the way down. Because you sold that put, you are contractually obligated to buy those shares at $330, even if the stock is suddenly trading at $200. You could be forced to buy shares at a tremendously steep loss. So yes, the strategy brilliantly neutralizes the cost of high implied volatility and gives you multiple paths to victory. But it introduces a hidden trapdoor. You really have to ask yourself when looking at the setup, is the potential reward of a perfectly financed bullish breakout really worth the catastrophic tail risk of a naked put if the stock totally collapses? It's a high-wire act of probability versus penalty. And honestly, that is exactly what makes the options market so endlessly fascinating. Thanks so much for joining me on this explainer, and remember to keep questioning the mechanics behind the trades.